taxes drive nearly every retirement decision. It's critical that you review your investments at least on an annual basis, if not more frequently. And what you're really reviewing is, how is the overall allocation? Income planning matters more than portfolio performance. Have a purpose in retirement, because I've seen it over and over again. It'll create vibrancy in your retirement. Probably the most frequent question that we get asked as financial advisors: when should I take Social Security? Welcome back to another episode of Retire and Thrive. Cammie is absent today. She'll be in and out over the next few weeks. So today, as we'd finished up, Cammie and I, the series on the book, we did 24 episodes. Today is episode 25. And today what I'd like to share with you is the feedback we've gotten, and maybe some of this will tie directly into the top 10 retirement lessons. And so today will be a little bit more specific, or a little bit more what I would refer to as tactical. So without further ado, let's dive in. The first lesson is retirement is a mindset, not a finish line. What I mean by that is, when I look back over my career, oftentimes people feel like once they hit retirement, they've made it. And I like to refer to it as retirement isn't necessarily a finish line or a destination, but really it's a journey. And again, we talked about in lesson 1 of the book about enjoying the fruits of your labor. And this kind of ties into that it is a journey. And as you approach, or in fact, if you are retired, that you need to embrace this chapter. This is the chapter that you've worked so hard for. And so it really is focusing more about the mindset. And it's not so much, I've reached the end here or the destination. So lesson 1, retirement is more of a mindset, not a finish line. The second lesson that I think is very critical, getting into more of the financial side of this, is that cash flow creates freedom. So let's just step back for a minute and let's talk about that cash flow. So cash flow, if you think about it this way, when you're actually working, you're actually receiving a paycheck every single pay period, whether that's once a month, every 2 weeks. And so that's what we refer to as cash flow. Once you retire and that paycheck stops, then you need to focus on, where is my income sources? In other words, oftentimes people look at their overall nest egg or portfolio, if you will, and there's typically a number that people associate that with. Like, once I reach a certain amount, then I'm good to retire. But as we talked about in previous episodes, it's not so much about how much money you've got. It's more specifically about the income that you have. So it's about living off of the income. In other words, if you've got an asset that's worth $1 million, be it your portfolio or real estate or even your home for that matter, it's not necessarily the value of the asset that matters. It's the income that that asset generates, which I'll touch on one of the other lessons here today as it pertains to that. But just remember that when it comes to retirement, the cash flow is ultimately what gives you the freedom. The third lesson is taxes. You know, we spent a lot of time talking about taxes, and I think this lesson I would just title, Taxes Drive Nearly Every Retirement Decision. So what does that mean? Why does taxes drive every retirement decision? Because, quite frankly, nobody wants to pay the IRS more than their fair share. And again, we've all worked very hard for our money. So once we get into retirement, taxes do make a significant difference. In other words, when you are in your working years, you know, I look at it and I kind of decipher and I say, you're either in the accumulation phase or you're in the distribution phase. And in that distribution phase, once you get in retirement, that's when we're distributing some of these assets. And when it comes to taxes, I look at things from a fairly simplistic standpoint. And the taxes are either into one of 3 categories. They're either fully taxable, like you might find in various retirement accounts, or they might be partially taxable, like let's say that you open up an account and it's non-retirement, but you may pay some taxes on the dividends and or capital gains. Or third, it's completely tax-free. And so why does that matter? You've got money that you've never paid tax on, again, typically in a pre-tax retirement type of an account, like a 401k or a 403b. Then you might have some non-retirement assets that periodically could kick out capital gains and dividends. And then the third bucket or the third tax type, I should say, is the Roth IRA, which is completely tax-free. And how does that drive retirement decisions? Quite frankly, what you want to do is you want to take a look and specifically get an idea of what your total income is. That could be from a pension. It could be from Social Security. If you've got other assets, maybe it's real estate income. But when you add all that together, take a look at what tax bracket that you're in. And then from there, it may make sense to continue to tap from the pre-tax that you've never paid tax, or maybe it makes sense to pay some capital gains, or quite frankly, if it's going to push you into the next bracket, maybe it makes sense to tap the Roth IRA accounts so that there's no tax on the Roth distribution, which would not put you into the next bracket. The fourth lesson that I want to talk about today is that investment review is not optional, is how I'm going to coin the title of that. And what that basically says is you must review your investments frequently. Now, what that basically is saying is as you approach retirement, things get a little bit more complicated. Your distribution strategies are going to change. I just talked about in lesson 3, some of the tax implications may change. And quite frankly, we live in a world today where we've seen lots and lots of volatility and things do change very rapidly. So it's critical that you review your investments at least on an annual basis, if not more frequently. And when we say review, what are we looking at? Are we simply looking at the value went up or the value went down? No, that's not it at all. What you're really reviewing is how is the overall allocation? Does it suit my needs? Overall, economically, are there some adjustments that should be made to the portfolio, whether it's specifically in the fixed income part, the equity part, or maybe it's the cash part? And again, I don't want to go too deep into this. Certainly, we could dive deeper into each one of these lessons. I'm just hitting these kind of on a high level. But ultimately, you want to look at your allocation and then potentially make minor adjustments. I said minor, not big adjustments, based on the economic conditions, whether that's to increase or underweight certain asset classes, or, for example, it may mean focusing a little bit more on shorter term investments that may provide that liquidity that we were talking about from the cash flow. The fifth lesson that I want to just talk about is that your withdrawal strategy matters more than the 4% rule. So this ties back again to lesson 3 when we were talking about cash flow. So let me take a step back here. What are we talking about the 4% rule? Well, there's been lots and lots of studies that have been done that usually talk about a 4% rule. And the 4% rule is simply saying this. If you were to take, historically, if you were to take your portfolio and put half of it into stocks, half of it into bonds, and you just simply put it into indexes, and you let it sit there, historically, you would have been able to pull out 4% every year and increase that amount every year by 3%. And historically, you could have continued that in perpetuity, meaning forever. Now, that doesn't mean that that's going to be the case going forward. I'm just simply referring to the studies that have been done have shown that 4% withdrawal rate is something referred to as a sustainable withdrawal rate. In other words, again, I like to use simple numbers here, but if you had $1 million portfolio and you pulled out $40,000 per year, i.e. that 4%, that's that 4% rule. Now, the actual rule in lesson 5 is your withdrawal strategy matters more than the 4% rule. So why is that important? Well, quite frankly, if you're in your mid to late 70s, that 4% rule might not apply to you because, quite frankly, your life expectancy is going to be a lot shorter maybe than someone who retired in their mid 50s. So the strategy in and of itself is more important than the 4% rule. I think it's important to keep that 4% rule into mind, but looking at your overall strategy in terms of withdrawal rates and basically at what stage you are in retirement is probably more important than just simply saying the 4% rule. Now, lesson number 6 is probably the most frequent question that we get asked as financial advisors, and that question is, when should I take Social Security? We get asked that question all the time. And I don't necessarily like this answer, but the answer is it depends. So I coined this title, Social Security decisions can ultimately impact your overall retirement up to a six-figure dollar amount. In other words, this is a very critical decision as you approach retirement. So, again, in the essence of time, I won't go through all the rules and all the nuances of this, but let me just start with a couple here. First and foremost, the window to pull out Social Security starts at age 62, and you can defer it as long as age 70. And you might be asking, why would I delay it? Why wouldn't I just take it all up front at 62? Well, because if you continue to delay it every year beyond 62 up until your full retirement, everybody's got a different full retirement based on their age, but right now the longest or the oldest full Social Security retirement age is age 67. So let's just go with age 67. So you can take Social Security between 62 and 67 in this example, and every year you delay it, it's not exactly 7% a year, but it's very close. So if you're going to get a certain amount at 62 and you delay it till 63, you will get an additional 7% increase at age 63. Wait till 64, you get another 7% increase all the way up until age 67. Now, even further from 67 to 70, in those 3 years, the government or Social Security will actually give you an increase of 8%. Again, think about it from the government's perspective. Every year that you delay it, that's less money that they're paying up front. I realize it's going to be more money for them down the road. And so which is the better answer? Do I delay it until age 70 or do I take it right away at 62 or some combination in between? Again, going back to the original first answer, it really depends. There's a lot of factors that go into this. First and foremost is your overall health, what you feel like your longevity. If we could tell how long we would live, makes this decision a lot easier. Second component that ties into that is your spouse. If you are married, is your spouse younger than you or older than you? Did your spouse make more income or less income? And all of those factors definitely play into that decision. So why is that probably the number one question that I'm asked? Because I think it has potentially the greatest impact in retirement. Lesson number 7, I'm going to title Income Planning Matters More Than Portfolio Performance. So income planning matters more than portfolio performance. So I would say the majority of us, and I'm quite frankly guilty of this as well, focus more on how much money did my portfolio grow this last month or this quarter, or quite frankly, how much did it grow in the last year? And what I'm trying to say is that's all important because down the road that does matter. But focusing on income matters more than your portfolio performance. So let me give you an example. If your portfolio grew by 8% and you ignored when to take Social Security, if your portfolio the next year only grew by 5% versus 8%, how big of an impact does that really make? Versus your Social Security, which I said earlier, could be up to a six-figure income decision depending on longevity. So we tend to focus on the cash flow. In other words, the income is what you're going to live on, not the performance of your portfolio. Don't get me wrong. Performance is definitely important. But I feel like a lot of that is just kind of socially talking about your portfolio. You know, you're at a party and you want to talk about your portfolio was up 12% or you did 11%. Somebody else only got 9%. And I hear it all the time. They talk about what my portfolio performed. But nobody ever says, by the way, I've got 90% of all of my expenses covered through all income sources. And again, whatever those income sources may be, nobody talks about that because it's not, it doesn't grab people's attention like my portfolio was up X. And so what I'm trying to say here in this lesson is that income planning matters more than portfolio performance. Lesson number 8, your plan should adjust yearly. And what I mean by that is everything changes. So I can use all types of scenarios, but when we build out these retirement plans and we're looking at the overall performance of portfolios, we're looking at incomes, we're looking at withdrawal strategies, we're looking at inflation, all of these nuances, all of these things that affect people once they retire, the plan needs to be looked at at least on an annual basis, because things do change. And again, I mentioned a few, but health changes. Maybe there was an inheritance that was received. Maybe a home got sold. Maybe a cabin was purchased. Maybe there was a home that got purchased down in Florida or whatever it might be. And then we talk about inflation, and we talk about performance, and we talk about income sources. At the end of the day, every plan needs to be reviewed at least every year. And number 9, this is kind of my rule that I try to live by, and that is simplicity creates confidence. Oftentimes what I find in my own personal life as well as portfolio is the more things that I'm juggling, the more balls that I have in the air that I'm trying to figure things out, it starts to kind of eat away at me, and sometimes it just makes me feel uncertain or lacking confidence. And so what I'm trying to say here is sometimes all of the complexities sometimes can be very overwhelming. And so what are some examples? I would say one example might be is if you have multiple accounts scattered, especially in retirement, it's really difficult to know with multiple portfolios at different locations what one portfolio is doing towards the other. In other words, is the left hand talking to the right hand? Are they in sync? Does one balance out the other? That's one area of concern. And if you're using different advisors to help you with that, maybe one advisor is very bullish and the other one could be very bearish. So they might actually not be working together harmoniously. They may actually be acting in the opposite directions. Secondly, as you approach retirement, as you get closer and closer to a specific age, currently at age 73, there's something called a required minimum distribution. RMD, as we refer to it. And the RMD simply says, look, you've been deferring this income, i.e. in your retirement accounts, for 73 years, or for most people, it's been the majority of their life. So let's just say you start working at age 20, 53 years, you've never paid tax on that money. So eventually the IRS says, okay, Mr. IRA holder or Mrs. 403B holder, you've deferred this income long enough. Now it's our turn to start receiving income on that, i.e. taxes. So at age 73, they're going to force you to start pulling money out based on current law. So what does that have to do with anything? If I've got 3 different accounts at 3 different firms, they each will have to calculate what that required minimum distribution is. And so it's 3 separate phone calls, it's 3 separate meetings, it's 3 separate emails, whatever it might be, 3 separate checks, 3 separate 1099s. And so sometimes just keeping things consolidated and simple can make a difference. And the last lesson I want to talk about in lesson 10 is purpose keeps people vibrant in retirement. I feel like when people are working, they do have a purpose, and whatever that purpose may be, whether it's they've climbed the corporate ladder, whether they've, went out on their own, started their own business, whatever it might be. But oftentimes when you're in your working years, that's where people are focused on what is my true purpose. But once we hit retirement, everything changes. Everything changes from the standpoint as maybe some of your best friends were your colleagues that you used to work for or work with, quite frankly. Maybe those colleagues were people that you hung out with, went to dinner with periodically, did things with. Also, as you worked your way up in the workforce, maybe that's part of what your purpose really was, is I want to make a difference, regardless of what your career is. But oftentimes what we find is that when people retire, their connections, their colleagues, their friends, if you will, are different. So there's this empty feeling of saying, wow, now who do I connect with now that I'm actually retired? I don't have the same group of 5 or 10 or 15 friends and colleagues that I used to work with. And sometimes even more importantly, they've lost their sense of identity. That identity when they were working was part of their purpose. And so when that gets pulled out from underneath them, now it's kind of like, what is my real purpose? And so I put that in as lesson 10 because I think it's very, very critical. And as I've been doing this for now 35 years, I've seen this unfold over many, many, many years. Retirement is such a beautiful thing. And again, I feel like people have worked very hard, and I feel like as you've retired and you get this window of opportunity to enjoy retirement, oftentimes people feel a little bit lost because of their identity or maybe some of the loss of their relationships. And so I encourage you, if you are in fact fairly new retired or approaching retirement, to take some time and really reflect back not only over your career and over your life, but as you enter into this new stage, embrace it with purpose. Think of the things that maybe are going to give you joy, satisfaction. And I'm not necessarily referring to just to-do lists here. I'm thinking more along the lines of what is it when you get to that last stage of your life and you're looking back or you're reflecting back in your 60s and even your 70s, and you look back and say, I'm sure glad I was able to do this or that or whatever it might be. So last lesson is have a purpose in retirement, because I've seen it over and over again. It'll create vibrancy in your retirement. So thank you for watching. If you found this podcast helpful and you want to see future episodes, just click the subscribe button down below. And until next week, we'll continue to bring these episodes to you. Have a great day.
Fortress Financial Group LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Fortress and its representatives are properly licensed or exempt for licensure. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All indexes are unmanaged and may not be invested into directly. Investing involves risk, including loss of principal.